Good morning, friends. Chris McWilliams here, ESDO Mortgage. Happy New Year. Hope everyone's January is off to a good start. And so, I've been a little quiet. We've been working. It's been pleasantly a little bit busy, not overly busy, but just enough to kind of keep us going for January. So, wanted to touch base on interest rates. I know it's on our minds. I think it's on the clients' minds, and then so I know it's on your mind as well. So we're going to go through some factors. We're going to go through this relatively quickly because I do have quite a few slides. So we're going to give you an idea of what we're looking at. So when we think about interest rates, first thing we want to just have an idea is what do we think the Fed's going to do in 2025? So when we look here, they do a dot plot. I think it's like every third meeting they do a dot plot, and they say this is what their expectations are based on where things are currently. So they change this quite often when circumstances change, but this is where we're at based off the last meeting in December. So we're at 4.375. Most of the Fed members believe that they're going to make two 25 basis point cuts in 2025. Right now, that may be a little bit, on the high side because inflation's kind of sticking higher in that 2 point in the high twos, right? And it seems a little stuck there. So 50 maybe might maybe best case scenario, but you'll see here later in the presentation that we have some factors going in our direction finally after 2 to 3 years of higher rates. So we'll kind of move on to the next one. So uh, the big things that the Fed looks at, right? They look at inflation and they look at employment. So the employment rate, they kind of everyone is kind of 14 members think it's going to be between 4.2 and 4.3%, and 5 members from 4.4 to 4.5. So can we get a surprise here? This is probably the most likely way to get more cuts than the two that are forecasted, the 2/4 basis point cuts, because the employment market's not as good as the BLS jobs report certainly says. And, we're kind of normalizing after, the COVID kind of period there. So this is something to keep an eye on as we kind of see what the unemployment rate does when the BLS figures come out. All right. So if the other factor that the Fed, looks at and you hear a lot about from the media is the inflation, right? So you have CPI and PCE. PCE is the more, you know, is the factor that they look at more than CPI, especially core PCE. So you're at 2.8 in November, and shelter, which is housing, rent, and mortgage there. So there's 4.8 year over year increase. It's overstated. We'll cover a little bit of that later as well. And then the rent index, right? So the way that the Federal Reserve looks at shelter, they look backwards quite a bit, and it's a lot of imputed data. So we have to be careful there. The rents are not increasing from CoreLogic as much as the way that the BLS is calculated. So we have that factor going there. And so if it was real time, if they weren't looking backwards 6 months or so, then you would see that, we have a 3.1% overstatement in shelter alone, which is having a big impact on the core PCE number. So it'd be 2.3 rather than 2.8. Does 2.3 move the market or change the Fed's decisions? It probably does. So that's going in our factor. Hopefully the lag that the BLS uses will kind of iron out here a little bit. So all right, so monthly shelter readings, you'll see here that a lot of up and down, but you can see the trajectory is very good. And then when the CPI and PCE reports that come out, there's the replacement from last year. So when you try to understand what might come out and what the market might do, you want to look at the replacement values that are coming. And so these replacement values are all pretty high in the next 5 months. So we have a good opportunity if we get a lower reading like this here, though, like a 0.182. This is very high, 0.498. We'd like to be somewhere between we'd like to be at 0.17, 0.125, somewhere in that range. So hopefully we'll see these replacements helping us in the next few months, which ideally would help the market, and we would potentially see lower mortgage rates. So inflation, here's a good graph of kind of what we've seen, right? Cumulative inflation. You'll see here, right? You see the big drops and the big spikes. So the big drop in the Great Recession, and then we've had this gigantic spike, really at the kind of middle of COVID all the way through. Now we're coming down, but you'll see we're still high, and we're still seeing prices increase. That cumulative inflation fatigue is certainly affecting our market, right? We see families certainly being more budget conscious because the cost of everything has gone up. So when that happens, you don't want to take on a larger home. That's really what we're seeing, or change homes if you have a great interest rate. So forecast for the BLS and unemployment here for this year. So you'll see also that unemployment's certainly on a trajectory of a rise from January 2023 to current. And so if we get that surprise, if we get to that 4.4 or to 4.6 range, you could see the Fed cut more. And if the unemployment rate rises, you would expect the bond market to force mortgage rates down a little bit. So that's kind of what potentially could be an expectation for 2025. And then when you look at the duration of unemployment is a good trending frontline factor too, and you'll see that that's certainly increasing over the last 7 months, 21%. That's a big jump up. You'll kind of see it here, like when that happened. So the factors are at play there for the labor market to surprise the Fed potentially. So something to keep an eye on when those reports come out monthly. Then we saw a lot of store closings announced at the end of the year, right? So this is a list of all those stores closings. That was up quite a lot. This kind of represents, I've heard from a lot of different business owners and different, just people on the street, and it just doesn't seem the economy's as good as people think. It really, I believe it is the cumulative effect of inflation, people just being more budget conscious. And so that is hurting business for sure. And so you see all these stores closings, right? This is actual stores. So, that's quite a few jobs. That's probably going to go through the market here in 2025 with initial unemployment and the unemployment rate. So, another factor that may be helping us this year. And the Fed looks at JOLTS, job openings and labor turnover, and you'll see that this is trending downwards. Nowadays, this may not be a real good indicator just because of multiple job postings due to remote work. So there's a little bit of just hesitancy wanting to put much value in the JOLTS report. All right, so we're here, 2025 mortgage rate forecast. So where could we go? So the 10-year Treasury to 3.6 or less would be welcome. And so you'll see here, this is kind of the spikes that we've seen. We see another spike that we're in right now. We had a little bit of momentum going here in the summer, and then we kind of got the election scare, and now we're back up. So we think that we're going to potentially get back down to 3.6, which would be really, really great. And then we've seen the average of the 30-year fixed rate mortgage bond and the 10-year Treasury bond generally has a correlation of somewhere between 1.6 and 2%. And you'll see here in times of economic distress, you'll see that this spread changes a lot, right? So the 2008 financial crisis, that spread changes, and then we normalize, but we overcorrect again, we come down, we get really low interest rates for a couple of years, and then we kind of normalize. Then we have the COVID spike. And so this should come back down and normalize to this kind of area. If that happens, that's also a factor that mortgage interest rates could get better. So we have a lot of long-term things that are kind of working in our favor for this year for mortgage rates to come down. And so within the next 6 months, we look at the 10-year Treasury, at 3.6%, which would be great. If the spread narrows, you're looking at a 30-year fixed rate at 5.85%. Maybe by June. Let's say end of June. Hopefully that's where we're at. We saw this past year when we were in the six or just under six that the market did react quite well. So I think this would portend to a more neutral market, and it would be welcome. We would see some families that have, their 2.5% to 3% mortgage be more willing to trade up at 5.85 compared to 7. So this is what we're kind of looking at. Interest rate forecast. So PCE is going to go from 2.1 to 2.2 from 2.8 currently. We do think the unemployment rate goes to that 4.5, 4.6%. The federal funds rate, they'll be between 3.25 and 3.5. Now that's more than those 10 members thought. We do think that the surprise here and the drop in inflation will allow them to probably cut 4 times instead of 2. And then mortgage rates are going to decline to 5.75 to 6% from around 7% today. So that's what we're forecasting for the year. That's a rosy forecast. I would love to see this. And the things that have surprised us over the past couple of years are the things that we don't know. And so, the new administration, what's the perception of tariffs? Now that's so far, just this week, it's been a little slow on the tariff front, which the market's actually reacted well to. Sometimes it's not even the actual inflation that may come from that. It's the perception of it, because the bond market may move based off perception, not actual fact. So now I believe the Treasury Secretary that he has appointed will, hopefully, guide him on the tariffs there. And hopefully we'll keep that in line. But we've had a lot of surprises, and most of the surprises over the last couple of years have been bad for the bond market and kept mortgage rates higher. So let's keep an eye on those surprises. If we have any surprises, I'll certainly keep you updated with our weekly mortgage update or so, and go from there. So I hope you're having a great start to the year. Keep in touch if you need anything, and we'll talk to you real soon. Bye-bye.